Hello investors and traders, they will speak about the stock market, inflation, economy and recession 2023. So let's start with the S&P. Here it's 4108 today. Of course, the main movement I think will be tomorrow. Tomorrow we have will be released the inflation data, the CPI. It will, and of course it will influence the market, the indexes a lot. So now it's decreasing channel, traded near here the higher border of this channel, and tomorrow or we getting out from here, we break it, or we can see this fifth weight and a little bit the S&P, SPY a little bit down. The Nasdaq today is growing about 1%, so its performance about 12% since the beginning of the year, and of course also the data tomorrow will influence the stock market a lot. Let's have a look on the oil price. Now it's Brent crude oil is 85. So look here, it's a weekly time frame. I think that it was the first wave, the second, the third. Now we have a correction, the fourth wave, and then from the Elliott wave methodology, I think we may see another move up. It will be the fifth wave. So now, by the way, there is side momentum indicator telling us that now it's this asset is already oversold. So of course we know that the oil price has like a huge amount in the inflation. So of course it's one of the inflation drivers, the oil price, the petroleum price, of course is the delivery and on all the other stuff. So we'll see. But now we see a correction in this asset. Last year it was higher than 100. Now it's so from its high level, we see a correction in oil price more than 30%, so quite nice. We'll see how the inflation data will influence this. The B2C, one of my big bets for this year, 21,000 now. Good performance since the beginning of the year, more than 30%. So now we are trading here, and I'm expecting my final target is 30%. So I think we may see B2C, of course, higher towards the end of this year. So I'm still continue to hold this asset in my portfolio. The US Treasury bond 4.5 for the 2-year, and the 10-year 3.7. So still the inverted yield curve, not a nice and a good sign for the stock market. It's signaling that the recession is very close, but of course we shall see how the inflation data, what figures we find in the report, and then maybe we decide if it's recession or not recession. So it's very high volatile instrument. And TLT, the ETF for the US Treasury bond, the bond market, its performance since the beginning of the year more than about 2%. I have a lot of my portfolio exposure to this ETF, so it's the 20-year Treasury bond ETF. We saw it was 160, now it traded near 100. My final target is 120. So I think it's one of the safest instrument in the whole market, the US Treasury bond, and I think now it's not so clear, not so safety situation in the markets, and I prefer to be in safe even assets like this one. So TLT, one of my big bets for this year. Let's have a look on this chart. So here we see the Fed balance sheet, we see and the S&P 500 index. So in my mind here, very high correlation between the Fed balance sheet and the S&P. So now last few years we see that the balance sheet is start to decrease, and of course it's a problem for the stock market. Yeah, usually if the balance sheet is increasing, also the stock market feeling well, feeling good. But now it's one of the main drivers for the stocks, the cash, the money in the system. And so now I think it can be a huge issue for this year, the Fed balance sheet. And one of the chairmen of Fed tell that the final sell from the balance sheet is not finished. We may finish it in 6 or 7 months. So I'm not sure that it will be a positive sign for the stock market. So generally speaking, in the near quarters, I think it may be tough time for the equities for the stocks. And here we see that the tech company, the Fangman, the US big giants continue the layoffs of their employees since 2020. We see that the last data of Google, it's 12,000 Meta, about 11,000 Amazon, 10 Microsoft, 10 Salesforce, and of course Uber, Cisco, Twitter, IBM. So generally speaking, a lot of IT companies, of tech giants, just continue to lay off employees. I think that it's of course about the recession and the artificial intelligence, and also that it's hard to support high level of salaries of wages. So that's why the companies just decide to cut expenses and to lay employees, unfortunately. So we see that it's a lot. Generally speaking, for example, Meta just slashed 13% of its workforce. So if you like investing, stock market analysis, so press the like button and subscribe to my channel. See you the next time.